talk about all the recap on, because we have a series right now, right? So we will be recap lessons for all the series information into these lessons. So by going through this lesson, even though you are a total beginner, you will get to know what is options, and you will get to know how to put option into your practical use. And even though you are not a beginner, you maybe can just go through together with us, and then you can get to know options in a very different angle. You can just know a little bit of insight or a little bit hints of how to just check the options from different perspective and angle. So I believe that when we go through these lessons all together, even if you are a beginner or you are not, you will also gain something from it, because it involves some of my personal skill when picking up the options. We'll wait for another 3 minutes before we get into the lessons. So for those that have no experience in options and have no idea what is options, can just practice into these lessons that you will know from the 0 to 100. This will be the most summaries, the most important lessons throughout all the series, I would say. And for the next week, I won't have any lessons, which includes Wednesday, Thursday, and Friday. Usually, I do have a lesson for these 3 days, but for next week, I will just busy in something else, and I think that maybe our live streamings will have a little bit of restructures, and the whole structures of the lessons will make some changes. I believe that this will help us to grow as a platform and to share more about the insight and the knowledge. Because I think that for now, the information and the knowledge that we deliver is wide too broad, and it's not in detail. And I hope that we can just do a lessons that can bring people from at least take the first step into the financial market, but not just bluffing on the theoretical part. And since many people just listen about the theory and then they didn't take action at the end, so hopefully by today's lesson, hopefully after the restructures, we will have more changes in the futures. Hopefully bring something good to the society and also to the company. So it's already 9 sharp, and we shall start our lessons right away. So I'm Hu Jun Lo, and you can call me Jay or anything else you would prefer, all up to you. I didn't care. And then I just share a little bit insight of myself. I have 4 years of experience in fund management and 2 years specialized in algo trading. And then I'm now a financial trainer for uSMART, and I'm going to share all the financial knowledge and also the insights that I get from this market. And also I will just teach you guys on how to just step into this financial world, and hopefully we can make some money together and achieve a target, which is retire earlier. So Yeah, still the same disclaimer as usual. In this class, we will not upsell you any classes, and we will not collect any of your personal information and your money from you. So if someone come to approach you with that purposes, please be aware that it might be a scam. So yeah, there's a lot of scam nearby, so please be aware. So in today's lessons, we will talk about all the essential knowledge in a nutshell, which we will cover what is the options, and what is the call options, the put options, the theory behind, and how do you just check it from the interface, and how do you place an order, and what is the factors that you need to consider when you're picking an options. So if you're a total beginner, after this class, you will be able to just, know what is the options and know how to pick it options and take your first step into the options financial market. And hopefully you can make some great money in the financial world and become the minority that will become very rich and wealthy at the end. The winner in the market is not who that is earning the most. It's about who's surviving until the end. And do remember that options trading is actually very simple. You don't need too many knowledge to just master it. Just one or two skill will help you to just generate your income and get a bit by bit and accumulate your wealth. So you don't need to know too much, and you just have to know the basic, and you can just play along with it, and you will find your way to make money out of it. Different people have different ways to just gain the money from the market. And even though we have four lecturers right now, four of us play option in a very different way. One of us like to being the seller parties and enjoying the happy that collecting the premium bit by bit and over the time. They enjoy the steady wealth that's coming into their wallet in a very routine way. And then the other ones who prefer a lead option. They like to just bet on the very good company, which is what we call a diamond company among all the company, and then they will just do it in a lead options way. They just buy a very long period options, and then they wait for the quarter report to be released, and then the news they release is going to reflect on the options price, and they can just benefit it and having a leverage effect. And myself actually like to play option in a doomsday way. I like to play the options that are going to expire within 1 week, and I enjoy the excitement they bring to me because first of all, it's cheap, so I have many chances that can just testing out in the market. I have many chances to get involved into different shares and different assets. So first of all, there's the first benefit is cheap. Second, I'm not the kind of person that have a very good patience in trading. So I would like to just quit my positions within a week. I cannot bear a positions that holding too long. I don't have that kind of holding power in me, which is also one of the common psychology mistake that found in most of the teenagers. And also I like the leverage that can bring from the doomsday options, because usually the doomsday option is the most cheapest among of those, and then the leverage is also the most biggest one. And I have my own skill in how to just find out a very good doomsday options to play along with. And so yeah, different of us have different skill in this market, and hopefully you can find one that suit you the most and you can make money from it. Okay, so yeah, just start on today's journey. So today's journey, first of all, we'll go through the call and the put options all together, and then I will make sure that all of you can understand it in a very simple way. I will just try to teach it in a very simple way, and then afterwards we will come into how does it play along with the interface, and what is the main factors that you need to pay attention to when you're picking up an options. and we will go into the real trading interface showcase, so that I will make sure you guys, after these lessons, even though you are the total beginner, you were able to know how to just put this skill right into use, and how to just pick up your first option to be trade and start your trading right by this night. Okay, so we'll just straight to the example, and we won't go through all those theory part. Waste no more time. We don't have time for that, and we just go through the example, so you can have a better understanding, and then we will just go through the practical part right away. So what is options? You might see that a lot of very lengthy, very boring explanation in the market, and actually option trading is very simple. It's just a game of space and time. And I will also compare it with the traditional stock trading and also the CFD or futures trading. And then you will able to see the benefit and the pro and cons also. And let's say this is the example that we are taking off, and this is the chart of the example. And since this is a game of the space and the time, so we'll talk about the space first. What is the space that I meaning here? First of all, the current market price fall on $100, and then on this point right away in today's, at the time that I'm crafting this PPT, so space meaning here is just the directions of the price movement. So first of all, the space here is meaning that you need to guess which direction that the price will going to head off. So you will either go up or go down. Without any additional information, they will just become a 50-50 chance in this case. So space is meaning you have to guess on the directions based on your own predictions or your own analysis. So you need to decide on the direction that it will going to. So you need to have a direction bias. And it's a game of space and also time. So what is the time meaning here? So the time meaning here is actually the expiration date of your direction to happen off. So you need to decide the time until the expirations. Every option have their own expiration date, and you vary in between days to weeks or even months or years. So you need to decide the expiration date that you are going to pick. If you're going to pick the options that have a longer expiration date, then it will become more expensive because it covers more uncertainties. So the shorter the time until expiration, the cheaper the option will be. So as simple as that, you just need to guess. It's a game of space and time. So the first of all, you have to guess on the directions, and you have to limit the time that for the directions to be happen. As simple as that. So if you are going to do an options reading, you just have to guess the direction, and that direction need to be happen within the time. As simple as that. And now we are going to call options. What is actually an call options? So a call options is actually betting the price to go up. It's very simple, just a betting for the price to go up. Let's say that in this same example, when you are buying a call, what does it mean? There is three important factors inside when you're buying a call. The first step is you need to select the time. We won't go into the theory part, so we'll just hopefully that you can understand it from this example. So first of all, you need to select the time, which is the first step that you are going to buy an options. Every options have their own expiration date. So in this case, the time that we select is 1 month options. So you can see that from now until the futures, there's a 30 days for that direction to happen. And when you are buying a call, you're actually betting for a bullish market. You are betting for the options for the share to go up. So in this case, we are going to use a 1 month expiration, which is 30 days. So it need to goes up before 31st December, as simple as that. And then you need to select the price. And in this case, we are going to select the price which is falling on the current market price, which is $100. And then what does it mean? It means that if the price goes up in this green area, then you will start to profit. So this green area is your profit zone. So it need to be above $100 and before 31st December. As simple as that. Select the time and then you select the price. And it will identify your profit zone. And the third step is, let's say in this case, when you're buying a call and the future price move in this way, and you can tell that if the price falling on this green zone, you are able to execute your call options right away and you can take a profit from it. Or you can either execute it to take the profit, or you can just sell the options back to the market. And also we will just illustrate how these two difference in the following example, in the real case example. So if the price fall on the green zone, you will be in profit. So there's two ways of exit. Either you execute the options or you can just sell the options back to the market. And if the price fall on below, you will suffer a loss. As simple as that. And the third one is when you are buying a call options or a put options, you need to pay a premium. So in this case, you are paying a certain amount of premium for this green zone. So how the premium will be changing when your green zone is affecting it. If you're lower down your strike price, in this case, the price that you're selecting, you will need to pay more premium because the green zone, your profit zone, is now bigger than the initial one. So you will need to pay more to cover it. The larger the profit zone, the higher your premium. So if you are going to just lower down your profit zone, just shrinking it to become something like this, then the premium will be a lot lesser when you're comparing to the first two. So you can adjust your premium by just changing the area of the green zone. Okay, so just now that one is the case for a call options where you are betting the price to go up. And if you are going to do a put options, you're actually betting the price to go down. And this is the case when you are betting the price to go down. Still the three same steps. The first one is you're going to select the time. And the second, you are going to select the price. And then at the end, you will need to pay the premium, just exactly like what you are going to do in a call options. The difference is just the direction. A call options, you are betting for a bullish market, whereby a put options, you are actually betting for a bearish market. So the first one, selecting the time. So in this case, we are still using the same expiration date, which is 30 days. So after you select the time and the direction, you already unsure about it, which is a bearish market, you're betting for it to go down because this is a put options. Then you are going to select the price. The price will be affecting the final premium that you are going to pay because it will affect the profit zone of your options. So in this case, if you are going to select $100 strike price options, then this will become the area that you start to profit. So at the end, you need to pay a premium. And if the price fall on this green zone, you are actually in profit in two ways. Either you can execute your put options or you can just sell it back to the market. So if the chart happen in this way, exactly like the same as the last example, whenever when the price fall on the green zone, you can actually exit with a profit. And then you actually also need to pay a premium for it, just exactly like the buying a call options. When you are buying a call options, you need to pay, and you are buying a put option, you also need to pay because you are buying things. Buying things need to pay money. So if you are changing the price, the strike price, then it will affect your premium pay also, because it will affect the profit zone of your options. So when you are lowering down, you need to pay lesser because the profit zone is now smaller than the previous one. But if you want to cover for more profit zone, you need to pay even more premium. As simple as that. Don't just memorize it. You can understand the basic, then it will be much better for you to just execute it. Now we will move into the live trading applications. In this case, I'm using the gold ETF as an example, because first of all, it's in uptrend because the EMA ribbon is now consolidating, and then it is no dead cross, and it is going to expand soon, and then and the price is actually come back on top of the EMS ribbons, and also it is on top of the solid support here. When you are taking the allocations of the fund, you can see that most of the fund allocated around 243, and that will make it a very solid support. So by combining these two bias, I'm actually prefer to go long in this case. I actually prefer for a bullish market in this case. So let's check on how the options will work on this one. So this is what you are going to look like when you are using the computer interface. If you are going to use a phone interface, it will be something similar, but it's not exactly the same, and it will be more simple. But if you face any problem when you are using the phone interface and you find something different, you can contact me. I will leave my contact at the end, and you can just contact the customer service also. They will guide you bit by bit. So first of all, you need to check the tickers. The tickers will be the asset that you are trading on, and every options is backed by asset. And in this case, we are going to trade the gold ETF options. So now you can check that the ticker is correct. This is actually a gold ETF. And then the next step is you're going to check the expiration date, because when we are buying the options and buying the put options, the first step is always check the time. You select the time first, then you select the price. At the end, you pay the premium. 3 steps. Remember these 3 steps. The first step is selecting the time, which is the expiration date. And in this case, I actually recommend you guys to trade the option with 1 to 2 months expiration date. Although I personally like the doomsday options, but the option with 1 to 2 month expiration date is actually much better, because even if this is cheap, this is also in there's more room for the stock to move, have a breathing room. So the next one is, the first step is selecting the time, and then the second step is selecting the price. So this is the second step, and this is actually the strike price, and you can tell by the color difference, it is actually separated into 2 zones. And then you can even scroll left or right to check for different factors, and there's 3 main factors that we will going to discuss later, which is the 3 main factors that I will put into consideration when picking options. So later on we will talk about it. And you can tell by the color difference, for this zone above, this is the options with a lower strike price when comparing to the market price. When the market price is currently falling at 250.96 cents, this, you can see that all the strike price are below 250. And then this is the option with a higher strike price when comparing to the market price. As simple as that. And on the left side, this is all the call options. Meanwhile, on the right side, this is all the put options. And I just remind you guys once again, call options, you are betting the price to go up, and put options, you are betting the price to go down. And now we will take a look at the call options, and we're going to refer to the chart, because at the chart there we analyze it and then we have a bias of a bullish market. So in this case, we are going to check on the call options. So let's check on how do we visualize this in the chart. Okay. So the first of all, also the same chart. Just remove all the indicators, and you can see that there's two vertical lines here that indicates the time zone. The time is 36 days until the expiration. So you are betting the price to go up within this 36 days. And then you are going to select the price. And this is all the available strike price that you are going to pick. And I will just show you a step by step on how do you visualize this. If you are going to select like this, you are select the strike price of 250, then you need to pay $575 for these options, because one option equal to 100 shares. So the premium of $5.75 is for one share. So you need to pay $575 for these options. So it's just the same when you're adjusting your strike price. So you are adjusting your profit zone. When you're adjusting your profit zone, you can pay lesser or you can pay more to secure for more profit zone. I will talk about how do you check on your profit afterwards. So if in this zone, the price did go up and it go to 554 in this case, then your profit will be $400, because it's very simple. You are profiting a $4 difference when you're comparing to your strike price. So just use 254 to deduct by 250, because that is the price that you select, and then you will get $4 per share. And do you still remember? One option is equal to 100 shares. So in this case, you are actually profiting 400. But in this case, if you take the profit now, does it worth it? I don't think so, because first of all, you are paying 575 at the beginning, and then if you're taking profit right now, you only collect back $400. So you will still have a net loss when you take into the cost that you pay initial as in considerations. So even though you are in profit, but you're unable to cover the initial cost that you pay. So if the price keep on going higher and higher, then your profit will be a lot more when you're comparing to the beginning. In this case, when you rise and achieve 259, in this case, you are actually profiting $9 per share, and that will make your profit become $900. And in this case, does it worth it to execute it? I think so, because you are taking a profit of 900 and initially you are paying a 575. It's able to cover your initial cost and then leave you a very healthy profit. So this is how the cost affected when you adjust the price. When you adjust the price, your profit zone will become bigger and bigger. You can see in this case, when comparing the first one, you can see the profit zone is actually bigger. So we actually need to pay more for a bigger profit zone. In this case, you need to pay $9.03 for each share. So you need to pay $903 for these profit zone. So if this goes up, and how to calculate the P&L? If this one goes to 254, your profit will become a $9 per share, because the price that you're selecting is 245. So you're using 254 to deduct by 245, then will give you a $9 per share. $9 per share, it will make you become a total profit of 900 because one option is equal to 100 share. So in this case, does it worth it to just execute right away? Not in a profit, but still okay, I think. You are collecting a $900 in this case, but initially you are paying a $903. So you have a net loss of $3. Even though you are taking profit, but this is unable to just cover the initial cost that you're going to pay. So if it goes even higher in this case, which is arrive 259, then it will leave you a $14 per share, and you will make your total profit to become 1,400. So 1,400, if you execute right away, you'll be able to cover your initial cost and leave you a very good and healthy profit. So if you are going to just smaller down your profit zone, shrinking down your profit zone, then you can actually pay less to just cover for this area. Now you are comparing to the beginning, you're paying a 500 something, and for the larger profit zone, you're paying 900 something. And in this case, you're only paying a 300 something for this profit zone. So you actually pay more to secure for a larger profit zone. So you need to adjust your profit zone so that you can adjust the cost that you need to bear with. And how does it compare to the traditional stock trading and CFD and also future? When you're comparing to the traditional stock trading, let's check on the result. When you are doing an options trading, in this case, I'm using the same example. I need to pay 575 for the strike price falling on 250. And then if it goes up to 259, I will receive a total profit of 900, exactly the same example as previous. And it will leave me a net profit of 325. In this case, you can see that comparing to my initial cost, I'm actually recover back my initial cost, and I make another $325. And the profit, if you calculate it in this way, I am in a profit of 56.5%, which when I put in the $100, I'm actually making $56. There's a lot when you're comparing to a traditional stock. So you can see the profit, the profit that you raise is in percentage is way bigger when you're comparing to a traditional stock market. So if you are going to do a traditional stock trading, you buy at 250 and it goes up to 259. Then you sell it immediately and you're actually getting a profit of only $9 per share. And this $9 per share, when you're comparing to the cost that you're paying initially, 250, you actually have a gain of only 3.6%. That is why many people come into option, because they want to have a very exposure to the larger leverage. Many people come to options because they think that they're able to flip their account into multiple X, into 100X in a very short period of time, which is realistic, but it's difficult. So this is the effect of leverage when you're comparing it to a traditional stock market. Then how does it compare to the CFD and also the futures trading? When you come to the CFD and also the futures trading, the leverage might be bigger, so the profit might be bigger. But what is the difference in between that make it better? CFD is actually lack of flexibility. When you are doing a CFD trading, first you need to identify your entry point, then like this one, and then you need to set up a stop loss order for your trading. Many people didn't set it and then they go to the liquidation and they go wrong. So The professional traders always set a stop loss for their order. They need to have a predefined risk. So in this case, if they set up their stop loss order at this previous support, and then what will be happen if the chart goes into this way? They will get being stopped up. Their stop loss will get triggered and they will quit their positions. Even though in the future it goes up, but they will have suffered a loss in these situations. So this is the main difference in between options and CFD. When options, you actually identify a profit zone. So you are not limiting that. No matter how low it goes, if at the end you were able to bounce back, then you will be in profit. As simple as that. You actually identify your profit zone. Meanwhile, the CFD, you have lesser flexibilities you have lesser room for the share to breathe with, have a lesser room for the share to move. So it need to be more precise when you're comparing to the options trading. When option trading, the most that you can lose is just the initial premium that you pay. Meanwhile, the CFD is depending on your stop loss order. So if you already plan to lose that amount for the stop loss, why don't you just go to the options? You have a zone, it's better than you limit that the room for it to breathe with. So when you're comparing to a traditional stock market, it have a leverage effect. And when you're comparing to the CFD, it have more flexibility. But if you are able to just get in and get out of the market in a very precise manner, then do ignore me. CFD is way more better for you because CFD have a higher leverage. You can make even more from the CFD. So now we're going to how do you check what to check when you're picking up an options. Simple. Personally, only these three things is important for me when I'm picking up an options. First one is the volume. Second is the delta. And the third is the implied volatility. I will explain why. So for the volume is actually ensuring for your entry and exit. Okay, so when you open up the interface, you need to check for the factor which is the volume. And when you find the volume, you can check the volume that trading for different strike price. And what does it matter? Because I do trap in the situation once I get into the positions and there's no trading volume afterwards. So I get trapped in the position even though I'm in a profit, but I'm not able to close my position because nobody take it from me. So volume is essential when you're going to ensure for your entry and exit. And for those that it's very hot option to trade with, those options with a higher trading volume, the bid and ask spread is actually way smaller when comparing to those that have lesser trading volume. So this trading volume also help in your trading spread. So do make sure that the trading volume fit your preference when you are picking up an options. For me personally, if I'm going to just trade for 1 to 2 options order within 5 orders, then a trading volume for about 100 will be sufficient. And then the second thing is, now you already ensured for your entry and exit. The second thing you need to check with is the delta. So this is how the delta looks like. You can also scroll left and right, and then you can find the delta. And then I will just show what the delta means for you, because the delta means the winning rate for this option. How do you visualize this? For the strike price of 250, you are having a delta of 0.422. What does it mean? It means that for the price to go up within the time durations is 42.2%. As simple as that. So you have the opposite percentage, which you can just know your winning rate in advance before you get into any positions. So now you already know that in the statistical way, for the price to go in your profit zone within this time duration, your winning rate will be 42.2%. And you will have a losing rate of 57.8%. And when the profit zone is bigger, you're paying more, you can see that the winning rate actually increased. Very basic, very makes sense, right? So comparing to the previous one, you have 42 winning rate, and this one, you have a bigger profit zone. Your winning rate can achieve 58.3%. And if you're just bringing down your profit zone, then at the end, you only have a 27.6% winning rate. So personally, I use this one before I get into any position to ensure that I'm in the side that the winning rate favor me. Okay. So also Delta do a different way that helping you to identify your profit in different way. So if you're going to exercise the options, you are actually paying 575 at the beginning, and then you profit a $9 per share, which makes your total profit $900, and your net profit will become 325, which is the exactly same example we did illustrate at the beginning. And what happened if you didn't exercise it? You're just selling your option back to the market instead of exercising it. How do we calculate it? Simple. You can just using the delta. But this one is actually the rough calculation method because there's the effect from the gamma and also the vega and the theta. So this one is actually just a rough illustrations, a rough calculation method for you to refer with. So if this one goes up to 259, and you can just see that there's actually a $9 rise from current market price. So with a $8 rise in the current market price, you just time with the delta value, and it will become $3.37. So you add on to the premium, you will make your premium to rise from $5.75 to become $9.12. As simple as that. With $1 rise in the market price, the premium will increase by the value of delta. I repeat again. With $1 rise in the market price, the delta will increase by the value of the delta. The premium will increase by the value of delta. As simple as that. So by this run, you can calculate that if you are not going to exercise it, then your premium will rise from $5.75 to become $9.14. And if you buy at the beginning with $5.75 and you sell afterwards, you will be in profit of $337. As simple as that. If you are not going to exercise it, then it will be 337. So when comparing to the first one, if you exercise that, memorize these numbers, 337. Comparing to the first one, 325, that is a little bit better. But in most of the case, when you are not going to exercise it and just selling the options back to the market, you actually have a higher profit comparing to exercise it. And the last factor that we are going to consider when we are picking up the option is the implied volatility. Implied volatility actually helps you to identify the fair rates of the option. It's just like the stock, they have a undervalue, fair value, overvalue things to talk about. So for the options, it also have the fair rate, and it will be identified by the implied volatility. The higher the volatility, the more expensive the option will be. So for this one, we check the IV, and you can see that there's a column called implied volatility. So using the same example in this case, you can see that now the implied volatility for this strike price is 15.78, and you have a Vega of 0.308. Okay, so now I just illustrate you how to calculate the fair value for these options. So let's say that this implied volatility usually fluctuated around 13%, and right now the implied volatility is 15.78%, which is higher than the average implied volatility that it should be. So you need to be checking on the average or the fair implied volatility that is going to fall on for the specific option that you are going to trade with. For stock, US stock, usually the implied volatility will be below 40. So I will just going to show you an example. Usually it will be falling below 40% implied volatility. So during the elections, the stock go up very crazily, and then the implied volatility even achieve 170 something for the Trump's related stock. So in that case, that options is very expensive, and it is not falling on the fair value that it should be. So in this case, whoever that buy it is actually buying at the top roof level, okay, the sky high level. So this implied volatility also help me to identify, am I buying an expensive options or am I buying an undervalued options? So in this case, how do we calculate the fair value? Using the Vega. With a $1% changes, the premium will be changes by the value of Vega. So if the implied volatility usually falling on 13%, and right now it's in 15%, then there's a 2% difference. And then you multiply by the Vega, you will get a negative 0.616. And then you just add on the negative 0.616 to the current premium, which is $5.75. You'll find out that the fair value of this option is actually $5.13. So instead of paying $575 for these options, actually 513 will be what it worth. So anything below 513, you are actually buying the options at an undervalued way. So we talk about three main factors, right? First one is the volume. Ensure for your entry and exit. And then we talk about delta. Help you to calculate the winning rate and also calculate the profit when you are selling back to the options to the market. And the third one is the implied volatility, which help you to identify, are you buying the options in an expensive way or in an undervalued way? Find out the true value of the options. This is the three main factors that you need to consider when you are selecting the options to trade with. So now we're going to the key takeaway for today's lessons. So options is actually just a game of space and time, because you're actually identifying the profit zone in the future. So first of all, you select the time, then you select the space. The space, which is the price, the strike price. And if you identify your profit zone, and you need to pay for a certain premium for that profit zone. And then Afterwards, you want to check for three main factors for your options when you're picking up the option, which is the volume to ensure your entry and exit, and the delta for your winning rates, and also for your calculations of profit when you are selling back the options. And the third one is implied volatility, which help you to identify the fair value of your options, and either you are buying at an expensive way or an undervalued way. As simple as that. And this is for today's lesson. So this is my personal VCom for you to connect with. And if you have any questions, you feel free to connect me. And then before the end of the lessons, I will also share a little bit of benefit if you're going to open an account in uSMART right now. If you are going to open a uSMART account right now, you're able to get a 0.02 share of Tesla. Then the more you deposit, you're able to get more cash voucher. And here is the QR for registration. The above one is the Singapore app, which is for global user, and the bottom one is for the Hong Kong user. So if you guys have any questions, feel free to ask now, or you can also contact me after the lessons by using VCom or VChat. And if there's no question from your side, then I just give a little bit forecast that on the restructure of our lessons. So we will just restructure the lessons to be a more practical friendly way, so that ensure that you can understand the theory and also put it into practical use. And then we'll also reduce the frequency of the lessons to ensure that a high quality lesson can be delivered on every lessons. Okay. So if there's no more question from your side, we will end for our today's lesson here. Thank you very much for joining, and I hope to see you guys afterwards. Thank you.